Well, good afternoon. Good afternoon and welcome to another Webinar Wednesday hosted by CSU Bakersfield Small Business Development Center. Good afternoon, I'm Kelly Bearden. I am your host for today and have a great program. Good to have our economist back, Dr. Mark Evans. We're going to be following up on a lot of what we talked about last week about getting credit ready, except now we're going to actually not only be credit ready, but also, we're going to also look at potentially looking at some of the resources that we can use that credit readiness for. So let's get going. Oh, it's great to be here, and it's here for March 13th, 2024. What is up today, March 13th, 2024? Well, I think you're ready. I think we looked at a lot of the credit readiness last week. We're going to look at a lot of the options this week that can actually help you in becoming a good candidate for small business financing, either through a traditional or alternative source. So we're going to look at a lot of those today. Our economist returns, and we have some great topics that we'll work with today. And so we'll get into a lot of the economic corner, as we call it here, our regular feature on Webinar Wednesday, and bring in Dr. Mark Evans in just a few moments. We will talk again about a lot about the employee retention credit and the amnesty program that is being offered by the Internal Revenue Service. It does end in just, a matter of a week or so, a week, 10 days. And it's really important to really look at the options that are available to you if you have the employee retention credit and maybe want to take advantage of their amnesty program. There's been a lot of upheaval. We did mention a little bit last week about the beneficial ownership information through the Corporate Transparency Act. We had just news off the press last week that it had been overturned in a court in Alabama. It looks like now there's, a little bit of upheaval over that, and really in the business of advising business owners on what to do, we're going to give you a lot of options and a few options on that as we continue to move forward with the beneficial ownership information. My part of the economic corner is going to be brief, and we're going to do a big capital quarter like last week. Our community calendar, we have a very minor community calendar for March. Really something that's really continuing to gel out there is the economic injury disaster loan hardship, your PPP forgiveness. As always, we'll take your questions. We'll take live questions following the end of the webinar today. And also, we will have a brief poll today. So let's jump into the poll question. And since we have our economist back, Dr. Mark Evans, who we'll introduce shortly, let's do a poll question related to him and his topic. And the question is going to be, according to a Nielsen survey, which Kern County produced agricultural product has been least impacted by inflation? Is it eggs? Is it milk? Or is it potatoes? This is a clue, and this is from a Nielsen poll that looked at the prices of some agricultural and other commodities back in 2020, and then again recently at 2024. And so they offered three commodities for us, one being eggs, one being milk, and one being potatoes. So in just kind of looking at what you have learned at the grocery store, give it your best shot. And we do have, about 65% of you participating at this time. To our one poll question of the day, which agricultural commodity has been impacted less by inflation, according to a Nielsen report? And with 75% of you, and we're going to conclude our survey today and share the results with you. And 73% of you say potatoes, 20% eggs, and only 7% milk. And by a slim margin, by a very slim margin, in a poll that caught me by surprise, it is milk. And only 7% of you were able to identify that. I think I would have gone with the 73% of you that said potatoes. But yes, potatoes, 73%, eggs, 20%, and milk, 7%. It's up our particular poll. So thank you for participating. And participating you did. And now at this time, is bring in our webinar Wednesday resident economist, and that would be Dr. Mark Evans, who is a emeritus economics professor, over 40 years at Cal State Bakersfield. He is a Faculty Hall of Fame inductee, I believe last year or the year before. Economist extraordinaire, Dr. Evans, come in and share what you have for us today.
Thank you, Kelly. Okay, thanks for joining us today, everyone. We're going to touch on two things. One, a federal budget update, and something actually happened, believe it or not. And Babson Colleges has a quarterly survey of about 10,000 small businesses. And we have a little bit of information available from that latest survey, which was conducted in late January. So let's talk about the budget first. This is the 2023-24 fiscal year, which you know began October 1st in 2023. So we're halfway through the fiscal year. And we actually have halfway through the budget, we have a budget for half of the federal government. So March 8th, Biden signed the first minibus, which was approved by both the House and the Senate. They had until March 8th to put this together and get it approved without a partial shutdown of the government in the areas listed under that first bullet, but they made the deadline with a couple hours to spare, I think. The second deadline is March 22nd. You see at the bottom of the screen there, the parts of the government that would be affected if we get a budget approved and signed by March 22. Everything's in order. If we don't, there will be a partial shutdown in these areas. So we have a budget. That's great. We don't always have a budget. Sometimes we go through the whole year with just continuing resolutions. But I'm here to tell you that there are a couple elephants in the room. One is that this budget approval doesn't necessarily mean the end of legislative gridlock. In fact, it doesn't mean the end of legislative gridlock. And then secondly, the fact that we now seem able to approve budgets doesn't mean that the increasing federal debt is being addressed by these budgets that are passed. My opinion is that these two problems will continue unless they at some point become single voter issues for us voters. You know, that we actually insist that they pass some procedural reforms, and then we insist that they address the Social Security, Medicare funding and the budget growing debt in general. So let's talk a little bit about why I'm pessimistic. I think what's happening is there's some gradually changing rules that are making it slightly, basically a little bit easier for us to get through and pass a budget and pass debt ceiling legislation. But I think, unfortunately, just about all the other areas of interest and concern, it's just as difficult as ever, possibly more so, to escape the gridlock. Let's take a look at why. Let's look at the House of Representatives first. There's a couple rules here, or the Hastert rule is more of an informal rule than a formal rule. But basically, this is a convention where the Speaker of the House will not allow a vote on anything unless a majority of the majority party is in favor of it. And this prevents consideration of a lot of bills that actually would have bipartisan support and pass pretty easily. The second thing, which is an escape valve of sort, but the problem is it's very seldom used, is something called suspension of the rules by the Speaker of the House. Now, the problem is that if you go by the rules, nothing can get done. There's so many ways to extend to pass, to offer amendments, to basically grind things to a standstill. But the rules can be suspended. by the Speaker of the House, and then the legislation that's then considered can be approved, but it would require two-thirds approval. No amendments can be offered. Debate time is limited to just 40 minutes. So basically, you get something that has bipartisan support. The Speaker says, I'd like to suspend the rules. Two-thirds of the voters in the House approve suspending the rules, and then a few minutes later, two-thirds of the House passes the legislation. Sounds great. Problem is that it's really not used very often. It's basically used in two areas. One is trivia, where I want to name the new post office going up in my town after a civic leader or whatever. The rules tend to be suspended for bipartisan votes like this that really are meaningless. And then at the other extreme, the rules have been suspended for gargantuan problems like trying to prevent the entire government from shutting down, either due to the debt ceiling needing to be raised or a budget needing to pass. That's fine. The problem is that the rules, a speaker cannot survive by suspending rules for anything other than the trivia on one end and keeping the government open on the other. So recently it was the bipartisan border legislation, any fundamental change to Social Security or Medicare, which are basically on a collision course of running out of money by the 2030s. A speaker would never be able to suspend the rules and survive their speakership. The guy on the top is John Boehner, who served as Speaker of the House from 2011 to 2015. Boehner often would ignore the Hastert rule, which again is just a convention, or suspend the rules to get important legislation that had bipartisan support through. He was subject to increasing pressure from his party. And so in 2015, what he did is he stepped down as Speaker and retired from the House. Now, we know who the guy at the bottom is. That's our former Representative Kevin. Now, what he did is he suspended the rules to keep the government open, to where it didn't shut down. And for this, he was basically deposed. Our current Speaker, Mike Johnson, did exactly the same thing, but he's not being deposed. So I think there's a kind of a gradual acceptance of the idea that, you know, if necessary, we should suspend the rules to keep the government open. The problem that Johnson has and that Kevin had is their majority is so small, just basically a couple votes. As long as things go strictly along party lines, they have to have every single person in their party supporting something. So hardliners can exert tremendous control over the majority party because you cannot get anything passed without their support. Now, you might ask yourself, well, why didn't Kevin or why doesn't Johnson go over, talk to the minority leader and form a coalition? Well, I think in essence, they do this and it's now allowable if it's just a matter of passing the budget or the debt ceiling, but for nothing else. The minority party, the Democrats, their position would be, well, we will support you as Speaker and backfill the votes you're not getting, but only if you form a stable and all-encompassing governing coalition rather than as a one-off deal on this one issue. So we're pretty much at a standstill in the House where it's very difficult to get anything done. But I think there's a growing acceptance of the idea that you should be able to suspend the rules and survive as a Speaker if it's for keeping the government open. The Senate has similar problems with the filibuster. you can pass legislation with a simple majority of 50 or 51, depending on who the vice president is. It requires 60 votes to end debate. So, and then you might remember the Jimmy Stewart movie where he goes to Washington and he stands up there for hours filibustering. Today, a silent filibuster is enough. You don't have to stand up there and talking, keep something from getting done. You just sit back, you relax. And as soon as somebody brings up a motion to end debate, you just simply vote against that. So it doesn't take much energy now to extend a filibuster forever. So this has evolved to the point where basically nothing even gets introduced anymore unless you're doing it for cosmetic and political posturing, unless you know right at the beginning that you have the supermajority of at least 60. Another problem is when these cloture votes come up, there's party tribalism. So you're not only thinking, should I vote to end debate based on the bill's merits, but you're voting on whether you want to end debate based on which party you think will get credit for the bill if it does pass. Now, again, there are exceptions, and budget reconciliation is the major exception. Then Supreme Court just budget legislation. There is gridlock, but they can get a budget passed. The problem is that these budgets that they debate so fervently on involve nothing but discretionary spending. And on this chart, what you see is discretionary spending as a fraction of the GDP actually is a smaller and smaller percentage of the economy every year. The bigger and bigger portions of the economy are Social Security and Medicare, major health programs. These are the ones that are exploding because of the aging of the population, but they're not even involved in the annual budget battles. You suggest that something be done about these, and you really open yourself up to political attack. So again, I think we're getting what we deserve as voters unless we demand that something be done in these areas. It's not going to happen. We're not there yet. Now let's talk about the small business survey. Babson College is one of probably the premier entrepreneurship programs in the country, and they conduct a quarterly survey of about 10,000 small businesses. The last survey was conducted mid-January, and Goldman Sachs extracts the data for around 1,500 participants, and then they publish a little bit of data, not a lot, but I do have access to that. It's available online. It's hyperlinked here, but let's take a look at some of the findings. Again, this is mid-January. Okay, which year do you expect to be the most profitable? This is pretty amazing here, but more than 50% of the respondents to the subsample expect 2024 to be more profitable than any of the preceding 4 years. So this suggests that the economy really has some momentum. Just a general question, the state of the economy. In January, 28% responded good or excellent. 3 months prior, it was 19%. So this is a pretty hefty increase. It's promising in terms of confidence, which is needed to really expand, assuming you can get the credit, which is another question altogether. The poor or very poor response, that the economy is doing poor or very poor, it was a third of the respondents in October. In January, it's down to 27%. So again, there's more and more small businesses that are saying the economy is doing good or excellent, fewer and fewer that are saying it's doing poor or very poor. Hiring, slight uptick. In October, we had 50% of respondents saying that they were currently hiring. It currently stands at 52. But then the difficulties in recruiting qualified applicants, it was bad in October. 79% reported that they had difficulty recruiting candidates with the qualifications they need. It's now slightly higher at 81%. And then finally, and I think this is a topic that Kelly's dovetailing into for the rest of the webinar, credit conditions. 35% of respondents applied for a loan in the past year. 79% report that they have difficulty accessing affordable credit. 40% of those who requested a loan received the loan in its full entirety. But this last bar is pretty interesting. 28% perceive the rate at which they were able to secure borrowing as predatory. So be interested to really see Kelly's comment on that, as well as all of yours. But this definitely implies, I think, that interest rates are going up. And with that, I'm going to pass the baton back to Kelly.
Well, thank you, Dr. Evans. That's fascinating stuff, particularly that 28% being predatory.
And that's perceived
So
predatory, so whether it's predatory or not, I don't know, but I'm sure a big chunk of it may actually be.
Well, that is fascinating, and that is a real issue. We mentioned the word credit cards today, and at one time in life, credit cards were considered predatory, and now they seem to be a bargain over some of the fintech deals that we talked about a little bit last week, where you're getting projects, you're getting funding in 24 hours, but it's 53% if you actually do the math and do the calculator. So last week, Dr. Evans, being my one-trick pony that I am, talking a little bit about inflation in the poll today, and a little bit about the Fed Chair Jerome Powell and his comments about inflation slowing, and if it continued to slow, that they could get it closer to the 2% inflation rate and bring down interest rates, and bring down those interest rates that are on business loans that are variable by nature. So there can be a reduction. And of course, after saying that, then a couple days later, it was slightly uptick, a little higher on inflation. So as we really want to see these rates come down, and I guess the cooling of the economy is what the Fed continues to do and wants to do, makes it harder for us to borrow at an effective rate. And so at an effective rate, we have last seen the Wall Street Journal prime at 8.5%. And many of the loans that we'll talk about, and some of them today, are based on that 8.5% plus a spread. And that spread can be as high as 3%. So we're getting into the 11.5 range. So, and they are variable by nature, and they do fall and rise with credit markets and credit policies driven by the Fed and general economic conditions. So that was my economic corner last week, a little, and you see at the very bottom, he returns, and see, I was true. Very, very, very solid prediction on my part. Okay, so let's talk a little bit about the employee reduction credit, the retention credit. Actually, if it was an employee reduction credit, that'd make a lot of people really happy, because then they might be able to find employees, as was referenced in Dr. Evans' survey question. But it is actually the employee retention credit. And we've talked a lot about this over the last several years, and there is the Amnesty program that's now available. And the reason that you might consider Amnesty is potentially that you took the credit and realized that actually the work that you needed to do as far as amend tax returns from 2020, 2021, maybe even beyond, was more work and more, more penalties and more other tax that needed to be paid that was worth it. And so, the IRS came out and said, we have this big mess on our hands. So we've paid out, I don't know, $250 billion, or maybe it could even double that, in the employee retention credit. And maybe they were sold a bill of goods from a marketing company. We at the SBDC, we really wanted you to go through your financial accountants, your tax preparers, the people that actually keep your records that would need to do those reports. But what they found is they charged around 20%. So they came back and they said, hey, 80%. If you return 80% of the money by March 22nd, you might not have to pay any interest or any penalties, or actually you'd get to keep the 20%, not have to file amended returns, not have to go back through that process of deducting the amount of your credit that you received from your wages on your tax return. And that is kind of like the problem. The problem is that you need to go back and you need to amend tax returns. So that is available for businesses just until March 22nd. There are other conditions that apply. So the Corporate Transparency Act, upheaval, I thought was pretty good word for this right now. Upheaval, yeah. It's been changing rapidly since it really got on our radar in the fall of 2023 and had started talking about it. It has changed a lot during that process. Don't you just love it when the rules continue to change on something that's really impactful for your business? And this is what the business ownership filing is. And so it does affect 32 million closely held businesses. Right now, as we mentioned last week, it was breaking news. There was an appellate court in Alabama that ruled it unconstitutional. And so right now, where it stands right now, is that I don't know. It's saying that it's unconstitutional. So businesses that are formed after January the 1st of 2024, be it they're an LLC, an S corporation, a corporation, some other form of businesses will also be drug into that they needed to file the business ownership information online by March 31st to avoid penalties. So we found that businesses that were actually created, those legal entities, those LLCs, S corporations, C corporations, certain nonprofits, potentially limited partnerships, etc., that were formed before January 1st of 2024 can wait till later in the year. And that seems like what most are going to do. But the penalties for this are going to be very, very dramatic if it goes through or if it is actually reversed, and who really knows. So again, what the reporting on that is to go through the government's FinCEN website and include personal information to fully identify the ownership of these particular entities. And again, it's going to really affect those of us that are small businesses that are 20 and fewer full-time employees. So it's really kind of in a state of flux right now. The government has said that they are likely to appeal that decision. So I guess stay tuned. We've also been talking a lot about PPP forgiveness. If you, I think high 90% of people that we have worked with over the last several years on PPP and all these other programs, they've gone through the forgiveness process. But if you haven't, there's still an opportunity potentially. I find out about a lot of the stuff we talk about on Webinar Wednesday through a lot of our providers, our government program providers, such as the U.S. Small Business Administration. And they're having the actual workshop in English on March the 15th. This workshop will be in the form of a webinar. I will be attending this Friday from 10 to 11. There's an opportunity for you to as well. The information will be in the chat. Maybe the more pertinent information than PPP forgiveness, I believe, is going to be on the idle hardship accommodation plan. So this idle hardship accommodation, there's about 1 million, idle loans around the country that are not in good shape. And really at the SBDC, we're encouraging our clients to do everything that they can possible to make those payments, because there are many reasons why the idle is really still an important program for them. We'll look at an example a little bit later on, if you sell a particular business, on how that might help you, on how having an idle, yes, owing debt, having a debt that you're legally responsible for, that you can move on with the business and help you sell and get a higher value for that business. So the idle program does have some real merit. We'll learn more about that. Check out your SBDC and your tools that you have. Live Plan, really a great business planning program, intuitive, interactive, one that you can actually use to actually produce a document, a business planning document, to help you maybe get some of the programs that we're looking at today and maybe help you in those particular areas. Obviously, business financials and financial projections, part of Live Plan as well, can actually be used and to help you assist in getting a small business loan. Almost all of our Webinar Wednesdays go to our CSUB SBDC YouTube channel. Have one coming up at the end of the month, a couple of weeks. Won't be going there. We'll talk more about that, but it's going to be a crowdfunding program. And part of our deal is that we can't put it on YouTube. So, but most of them do go there. And our CSUB YouTube has probably around 275 videos now. Most of them Webinar Wednesdays going back over the last 11 years. Our California Human Resource Hotline for employers, which is a partnership with the California Employers Association. You can call and get free advice on HR. Who doesn't want free advice on HR? I don't know, though. I don't know. There's a list of the counties in the San Joaquin Valley and the Sierra Foothills and the Eastern Sierra region, maybe some also on the Central Coast. Call your particular hotline based on the county that you are actually residing in. So let's get into a lot of what we follow on from last week. And our follow on is going to be, last week we talked about credit ready. We talked about a lot of the basics for getting credit ready and for enhancing your opportunity and your chances of getting a small business loan or other type of funding. So last week we did, just kind of as an overview, talked about that, the one key thing to remember is that it's subjective. There's not any one rule, hard, fast explanation on, or one loan that fits or serves everybody. So it's subjective. It's what I think is a great loan. Somebody who's one of my colleagues might say, they don't think it's so good. So there's no scorecard that exists. There's many factors that have to be considered, and really looking at those factors and understanding those particular factors make you credit ready and help you with your application once you seek credit. One of the rule of thumbs, the 5 C's of credit. We looked at, a lot of the issues that lenders will look at as far as your credit history, the condition of your business or industry. Industry plays into a factor too. And not only your industry now, but where's your industry going to be in 5 or 10 years? Is your industry going to be affected by AI? A lot of different factors that pop up. Your capital's generally capital that you're investing in your particular business. And also collateral and character. And, size matters on loans. A $10,000 loan is completely different than a $1 million loan, and a lot of the application will reflect that. And it's always important to remember that if you've banked with a big bank for 27 years, it's not going to carry any value. And that person that you're sitting across from, they might barely be waiting for your loan to be done and approved, but really, it's somebody else who's going to make the ultimate decision and is going to overwrite that particular loan. And so the underwriting process is right here, and it's going through, a lot of different conditions. And we looked at a lot of that last week. We looked at a lot of the current planning trends that were going on, where people are doing pitch decks and business model canvases, in addition to maybe even getting by with a description of their business if you're an existing business with historic cash flow. And of course, we always define historic cash flow as that number comes off your tax return. It's proven, it's vetted through the IRS, it's official. It's not like your generated profit and loss statements. Historic cash flow is vetted off of that tax return based on certain adjustments. So we also looked briefly at the use of funds and about how, depending on how you use your money, that you're going to actually, and how important it is to be able to identify to the lender what you're going to do with it. Are you looking to refinance debt, for example? Maybe $25,000 of this example here for a $100,000 loan is to take out more expensive debt. Now, if Dr. Evans mentioned the predatory lenders, and these are the lenders that merchant advances. There's a number of different organizations out there that'll give you a fast loan and will not provide you the interest rate. And again, what I like to tell everybody every chance I get, so I'm going to say it now, is that if you refinance one of those loans, you've already paid the interest on it. So if you have a loan for 2 years, it doesn't do you or serve you in benefit by paying it off early. A regular amortized loan, like a mortgage loan, where you have an amount, for example, sure, yeah, that helps. But really, refinancing debt and using the funds are not going to really benefit you unless it's really a significant cash flow drain and getting better cash flow terms. That's the other problem with these predatory loans. Cash flow. Cash flow grinds you down because you're paying every single day. In this example, you're purchasing equipment, but being able to identify just your use of funds is really beneficial in moving it forward. Last week, we talked about some of the lending resources that you're going to want to have in your toolbox. You're going to want to have potentially a lending checklist and also some of the benchmarking industry information. Knowing how your business works in a particular industry, how it reflects either financially favorable or unfavorable, is how you get that intel information. You go through those benchmarking and you go through some of the resources that are out there. LivePlan has that, for example. Will show you how your business is comparing to your industry. And why do you need to know that? I think you might ask. Well, I'll tell you, because your lender's looking at that. And your lender's comparing your business on how it is in the industry. And if they have an industry sample of 500 businesses that are the same, maybe asset size and sales, and they have a percentage of how your business does from a profit and loss perspective, they'll look at your balance sheet and maybe some financial ratios, but they can compare your business on how it is performing against the industry you're in. So that's all good to know. And also other things such as a credit report and working with your SBDC consultant or advisor. So of course I had to throw my calculator out there and I have to throw one of those predatory loans. And, you know, the reason that they're predatory loans is that they don't always identify what that interest rate is. So you see an interest rate here of 49.49%, and you have to remember that that could be nowhere in any of the documents or information that you receive when you receive this particular loan. What you know is that you're getting a $50,000 loan and you're repaying $120.67 every day, and that your total interest charge is going to be $23,456 on this particular example, of which this is a 20-month loan. And so you see, you're going to be paying $23,456, whether you repay it in one day or if you go the whole 20 months term. So that is really one of the issues. And so really in this example, through my loan calculator, I'm able to figure it out as a 49.49% interest rate. Really not an interest rate that's really conducive to helping a lot of small businesses. Okay, so let's get into a lot of the loan resources that are available and some of the programs. First, I want you to look inside your business. And if you have a business, maybe you can come up with cash from cutting inventories, maybe being leaner on purchasing inventories and taking advantage of maybe getting it quicker. Your product that you sell, maybe doing other things to cut inventories. You can also offer a cash discount or maybe a trade discount. So you can have tighter collection policies, and that's the cash discount. But you can offer cash, cash can come by offering trade credit and negotiating maybe a better deal with suppliers. So always look inside your business first. And then let's look at traditional funding programs that are out there. I think everybody knows the SBA loan programs. And, SBA loan programs are designed to be a lender or a provider of funding that clients or business owners cannot get if they walk into their local bank. So, they're designed to assist people by providing oftentimes loan guarantees, but also other programs. So next week, we'll talk about SBA lending programs with our special guest, Lisa Carvajal, and she will talk about the fixed asset loans from SBA. So there are two types. There are fixed asset loans that are for the acquisition of fixed assets, land, building, equipment. Since we'll talk about that next week, let's talk about the guaranteed lending program. And that is probably a little bit more universal because it goes for a little more assets. And generally, there are SBA lenders at banks that will make the loan, and then they receive a guarantee from taxpayers in the amount of, between 70 and 85%, let's say. So these programs are designed to be revenue or expense neutral, meaning that the loan fees cover a loan loss reserve, so they cover the loan programs. And that is why there is incentive to provide the lender with a guarantee in the event that the loan is not repaid. So that's SBA lending. So also we have also business lending through banks that, it's kind of a traditional source. It is usually provided to businesses that have been around for quite a while and have sufficient cash flows to justify. It's the basic, but not always. It's the basic loan to somebody who really doesn't need a loan. I've heard that before. So, but business lending is based on without the guarantee, and lenders, nature can only have 2% of their loans go bad and still be solved. So, they have to be very careful. They report to board of directors. They have regulators that come in and look at the quality of the loans that they make. So a bank might want to make a loan and can't because of other reasons. So because of that, business lending is generally those, but not always. I have seen instances where business lending is done on a direct basis, where it is a newer business, but still it's generating cash flow. So we talk about permanent working capital and term loans. These are the types of loans that are made. So generally, a common loan will include permanent working capital. It could include purchase of assets such as equipment, furniture, and fixtures. All goes into that term loan. So it could be a variety of factors that go into it and a variety of uses of those particular proceeds. So term loans are by far more common. Lines of credit are less common, but they are traditional funding. They are used mostly for either a seasonal type business that has a seasonality to it, or an irregular business practice. So for example, if you have a restaurant, and typically, it's not driven by any particular tourism aspect of it or seasonality. Generally, you would be looking at more of a term loan rather than a line of credit. The line of credit would be for a company that maybe is a manufacturer and they sell 80% of their sales come from the holiday period. So they sell Christmas lights, fake Christmas tree, who knows, but maybe something that's generated toward the holiday season. Or it could be that they're seasonable business because of tourism, and their tourism season only lasts the summer. Those are excellent opportunities for lines of credits. And line of credit is you borrow the money when you need it, you repay it when you earn it back, so you don't have to pay interest on it the entire full year. So those are the two common types of loans. Permanent working capital is something that is really something that is needed in most businesses. State and local business lending programs, for example, exporting programs as well. So when we get into a lot of this is kind of a quick kind of like a synopsis on a type of debt funding and type of equity financing. So debt funding are loans that you pay back. Equity is generally money that is invested in your business, either through a partnership, could be crowdfunding, it could be a lot of different aspects. So it could be an angel investor, it could be venture capital, it could be even a strategic partnership for that example. So kind of shows you some of the things that you might need as far as a credit score, how fast it can happen. What you're going to need is the column on your left. And then kind of on the right is if you're leveraging some of your own assets. And there are a lot of people that will come to the Small Business Development Center and say, I want to start a business with retirement funds. And after I really tell them, I don't like that idea. I really don't. Oftentimes they'll go ahead with it anyway. And there are ways that you can do it that are much less punitive, I should say, much less punitive, and give you a better chance of success if you really want to do that. So also leveraging accounts receivable, a thing called factoring, where you can actually be paid on an invoice up to 75% of that invoice in a day or two. Again, it is really helpful if you only need it on a once or twice a lifetime or annual basis. But if you get kind of addicted to it, the cycle really kind of tends to drag down small businesses. Now, going back to my idle example of why you really want to keep that idle going is this is an example of people that have come to me and said, I want to buy a business, or I want to operate a business or get a business loan with zero down. I don't want to put anything into it. And, it is possible. Lenders really like to see, that term that I really don't like, skin in the game, but kind of fits here. But there is an example to where it could work, and it involves buying a particular business in this example. So again, it has to be a real solid deal. And let's say there's a business for sale for $500,000. The cash flow from that business is really good. The applicant is going to have a good credit history. There's going to be collateral that's going to be pledged to cover the particular loan. And in this example I'm using nowadays is the new owner assumes the old idle loan. So again, you have an idle loan that's at, $200,000 for 3.75%. You got it during the pandemic. It was for 30 years then. It's now, say, 27 and a half years. So let's say the new owner assumes that idle loan, and the EIDL loan can be assumed. Carry back 30% or more would be carried back by the business owner and would have to be done interest only. And then a 7A loan, an SBA loan, would cover the rest. So the structure of this deal is you have a $500,000 project. You're assuming that idle loan is basically 40% of the debt at $200,000. And then also the owner financed is 30% of the deal. And the new loan, an SBA 7A Community Express loan. So let's see how that works. So here are the terms that could actually happen if you had the particular deal structure. You have the idle loan that's assumed, which is an asset to both the person buying the business and the person selling the business. I can't stress this enough, how valuable this loan can be to both a buyer and a seller. I think it increases the value of the business, even though it's debt that needs to be assumed by the would-be buyer. And the would-be buyer is getting it because it's so much of a lower interest rate and for a much longer favorable term that it really helps both parties in this transaction. So you have that at the cheap rate. The owner then maybe offers a 7% loan, interest only for 5 years. And then the loan is amortized over 5 years. Now, why is it 5 years? Because you're going to have an SBA loan that is fully amortized over the next 5 years as well, which would be the last piece of this puzzle. And so that being the current market rate, 11% that we looked at earlier today. And so how does that all figure out from a pricing standpoint? So you look at those three, and I'm looking at only the payments. And so the payments for the idle would be $926. The owner financing interest only would be about $1,100, and paying off a 5-year loan for $150,000 would be about $3,200 a month. So a total of $5,354. So if you're looking at, doing that, from a cash flow perspective, $5,300 is a lot better than looking at an SBA loan that, say, at 11% and 5 years would be $10,000 a month. It would be for a 7-year loan, $8,500 and change, and a 10-year loan, $6,887. Now, you still would need to, after this wouldn't be paid off over 5 years, you'd still have time to pay on the idle, and you'd also have an amortization to go here. But early on, it would really help from the cash flow perspective, having the smaller payment and getting things up and going, and particularly in business those first 5 years. So an example on how creativity fits into the lending process. Oh, you can go with one loan here and also look at other creative ways to make it even cheaper. Strategic partners. You know how I love strategic partnerships as I run out of time. And strategic partnering is another way of actually funding particular deals. There's other alternatives, such as equipment leasing. So you can do it over an operating lease or a finance lease, two different products. One covers the cost of an asset and one does not. The one that's most common is the loan that actually covers the entire amount, but a leasing option is a good option. Oftentimes, people will still need to use their real estate as collateral. So if you have real estate equity in, say, a rental or investment property, hopefully not your residence, it can be accessed in order to do the business as well. And also we look at credit cards, which, I know you tuned in to sit here for an hour to let me talk about credit cards, but over the predatory loans at 24%, they're a much better deal. The cash flow aspect's better. There's a minimum payment that really, I hope you pay more than the minimum payment, but actually, if you can get into a credit card that actually is fairly limited on interest rate and you check the terms and you're able to repay it, way cheaper than some of those predatory loans. So oftentimes we look and see, is there money for everybody? And there's a lot of different programs that are out there. I don't believe there's money for everybody. I don't think every project that I hear should be funded. And sometimes that's in the best interest of those that bring them forward. At the SBDC, it's not our goal to get everybody funded. And in business, it's our goal to make the best decision for you, to provide the facts and let you decide if it's best for you to go down that particular round. So, there's a lot of different loans that are out there. There's community revolving loans. There's a lot of transactional lenders that just want to lend on the transaction. There's state guarantee programs. We do have those through the state of California and more of those to come. Microloans are out there. We've talked a lot about CDFIs in the past. We've talked about credit unions. We've talked about lenders also that are non-SBA lenders. There's your online lending sites, your fintechs, which oftentimes go follow that predator, 49% interest. And there is a use for them in certain situations, if it's something that has to be funded within a day or so. And it is such an extraordinary deal that you can live with those particular terms. Hard money, is a great, if there's real estate involved, we've seen some great deals that were actually purchased on hard money. We're able to refinance out of them at a later time. We'll be talking about crowdfunding in the next few weeks, venture capitalists, angel investors, and some veteran unique lending programs. There's a lot of money out there. There's a lot of unique ways of actually getting a business loan. So it comes down to, can you afford it? Can you afford it? Looking at your personal situation and looking, can you afford more debt? And that's another thing that we all like to see. Okay, so I'm out of time. We'll be back next week, but before we actually get into next week, let's run through the chat real quick and look and see just some of the resources that are in there. After the greetings and the salutations, you'll see information on what Dr. Evans talked about on the business survey. There's also information on some of the programs that we talked about. Trying to see if I can find a question in here. Here's a question on LLC. Became an LLC in late 2024. I believe that's late 2023. Received a letter from the state about filing quarterly. We do have an expert at the SBDC on entities. I would suggest you potentially talk to our entity expert if you have any LLC or incorporating questions. There's a lot going on in those areas, and there's a lot of stuff that doesn't get filed and a lot of problems that people run into when they get into the legal entities of LLCs, corporations. There's a lot of filings that have to be done. There's legal annual meetings there's minutes that need to be kept. And in order to keep those entities in place, it is just not filed and set up. So, talk to our legal expert, our legal entity expert at the SBDC. Comments on the hardship accommodation through the SBA, and really kind of looking forward to that on learning more. And it tends to evolve and change, so I can't keep up with it. We do have a question in the Q&A. How can you get access to LivePlan? Well, LivePlan is accessible to SBDC clients and SBDC clients. And if you have an SBDC consultant that utilizes, reach out. I'll reach out to me in an email at kbearden@csub.edu, and I can provide you more information on that. Okay, it looks like we're done. Another webinar Wednesday in the book, number 312. We'll be back next week, 313, continuing talking about lending. It's our business lending march, our march toward getting capital. And we will have Lisa Carvajal with the SinCal Business Finance Group. So for Maureen Busher-Dang, Dr. Mark Evans, I'm Kelly Bearden. Everybody have a great day and a great week, and we'll see you next week. Goodbye, everybody.